let's move to our big conversation this morning, and we're thrilled to be joined by Devina Mehra, founder, chairperson, and MD of First Global. Devina, great to have you on NDTV Profit, and hope you're doing well. Let's just start with the show of faith that Indian investors have displayed through, I would say, 2 or 3 big events since April this year: trade tariffs, Operation Sindoor, Iran-Israel war. This is, the fear of World War III. Through all of that, investors have been rock steady. Do you think that they're being overtly optimistic?
Good morning, Tamanna. I don't think so, really speaking, because my view, I was just looking at some of my February interviews because my book had just been launched. So I did this series of podcasts. And all of them, I said the same thing, which was that if you were waiting for a correction to invest, have you invested? And the market is up, I think, 14, 15% maybe from those levels. So this was as I expected. Of course, Operation Sindoor was specific to us. Otherwise, again, geopolitical turmoil elsewhere does not have a lasting impact. I was again looking at a video that I made 3 years ago when the Russia-Ukraine war started, on the day that it started. And I said that what our analysis tells us, and we looked at 50 years of data of any kind of major geopolitical turmoil, so whether the 2 Gulf wars, US bombing Libya, Afghanistan, 9/11, so around that event, at times there is turmoil, but that never lasts. It wasn't a statistical thing. It was in every single case. So you didn't need to say that there aren't enough data points to do a statistical analysis. It was there in every single case. And if we do come to a World War III, then I think we have things other than markets to worry about. But short of that, it is only the direct impact that if it disrupt supply lines or some commodities. Other than that, there is nothing that affects markets at large. Markets being very narrowly focused, they don't care about human cost and all those things. And as far as the Trump tariffs are concerned, again, India's exposure to exports in general is limited. So, that was one reason probably that it didn't cause a major upheaval. And in any case, we still don't know what the final picture will be, because soon after that, there was a rollback of sorts in what he had done. So it is only, the lasting impact, I think it would be on the US and what the world thinks of the US and the solidity of its institutions or rule of law. And that will, to my mind, take away a lot of gloss from the US, because the US was not just a rich country. It was a country that had built itself up on its at least image of freedoms, and which therefore attracted the best and the brightest from the rest of the world. And that part you are shaking up, and that will not be easily restored.
Devina, pleasure talking to you. It's been a while. Thanks for joining in. What's the sense from here, Devina? Because optically, you could argue that Indian markets are in expensive territory, but then they've never been cheap. But there are, but the one view that is coming is that if indeed the markets stay stable, then a lot of non-Nifty 100 pockets, which have the possibility of showing growth, might actually give good returns for investors. Would that be fair assumption? And is that the pond that you are fishing in as well currently?
Nifty, of course, is only 50 companies. So you do, of course, look at beyond that. But on the other hand, I am not also, and never have been even in the last year and a half, in the absolute micro cap or very small cap range. So that, again, is a risky area where you have to pick and choose. And anyway, you have to pick and choose. So our view still remains reasonably okay on the relatively large caps, which is not just, as I said, not just the Nifty part of it, but relatively on the, let us say, the top 600-700 companies is where we would look at. But again, it has to be sector specific. It has to be company specific always. the risk is always higher in the small and micro caps. And as people would have seen in this fall and rise of the index, also that all the stocks that had run up last year are not all of them have necessarily recovered. So that's the way that segment of the market plays out.
Okay. Devina, I'm tempted to ask this to you, right? You're known to be a person who doesn't quite go out and think of banks as the first port of call on most cycles, right? But there is a new Reserve Bank which in the last 6 months has shown a lot of flexibility and given a lot of measures to enhance risk-taking. Almost everybody unanimously believes that NBFCs in particular, and maybe banks as well, are a sure shot candidate for returns over the next 12 months, considering all that's happened in the last 6 in the new RBI. Would you beg to differ or would you concur?
Okay, Neeraj. So first of all, yes, I have always been a nervous investor in banks and lenders. And in my recent column in Mint, I had set out why. But as I had written at the end, this is probably the time I have been most positive on banks in the last 3 years. So if you look at the last 5 years from 2020 to 2024, so the bank Nifty underperformed the Nifty in 2020 when it was the only sector in the negative, in 21, in 23, and 24. So the only time that bank Nifty outperformed the Nifty was in 2022, which is when we were market weight on banks too. And while we are still not market weight, but both in our January rebalance and April rebalance and a little bit thereafter also, we've been increasing our exposure to banks. So, I mean, they've spent a long time in the wilderness. So I think, definitely that is one of the sectors that is looking better. I think that's among the major sector indices. That's the only one that is higher than where it was in September. But you talked of the RBI. I mean, I find it a little funny because, when the RBI raises rates, that is when the margins for banks go up. Because what happens is that the loans or the asset side, basically the new interest rates comes into effect more or less immediately. Whereas for the deposits, the rates go up only when the deposits come over for rollover. So that the margins actually expand on the other side of the cycle. So, I mean, often it happens that whatever the RBI does, for some time, the headline is that it is good news for banks. So the rates go up, the margins will go up. If the rates go down, the credit cycle will revive, etc. But that's how, I mean, of course, RBI has this time softened the blow, so to speak, by also reducing the reserve ratio so that the banks can actually lend out more. But ultimately, the demand for credit, I don't think really changes with a 0.5% or 1% interest rate. So if a company is not going to do, let us say, capex, it is not going to start doing it because the rates are 0.5% lower. So that part is, and there are still risks. I would not say that go all out and buy lenders, because I think on the retail credit side, there are definite risks. And also you talked of banks and NBFCs or so-called, fintechs and this and that. But you have to be careful because often the NBFCs are lending to people whom banks will not lend to, people or entities. So they are usually lower down in terms of the credit quality. So often the first signs of stress come there rather than the banks. So those are the things to keep in mind. So it's not like just go out and buy any lender, but definitely the banks are looking a whole lot better than, as I said, definitely they've looked in 3 years.
Devina, what is the pocket that is exciting you right now? Because we've seen a fair amount of run-up valuations, and that question about valuation is back in the picture after about 6 months. Are you finding IT as an underappreciated pocket, or is that story done and dusted? Real estate, defense, consumer, what is exciting you right now?
So, I mean, there are 2 sectors where we have been overweight from almost the beginning of 2024, and over time, at least pharma and healthcare has become more overweight. So that in terms of relative to the index, that's probably the sector we would be most overweight in. And also, as I said, auto components would be somewhat overweight. In terms of IT, we would be slightly overweight. We're not like taking a huge bet, but yes, I mean, I'm reasonably fine with IT. And that's a relatively predictable sector, which I think is underappreciated. That this is one of the sectors where, at least to some extent, you can say how the trajectory would be relative to many others. I mean, there are, of course, there might be like a 2% point plus minus, but even that much of predictability is rarely there in any sector. In the last couple of rebalances where things have, our systems have started liking, and therefore we have been buying stocks, is FMCG. So FMCG now we would be relatively overweight, and not always in the really the largest companies, but there are a whole lot of names in that that have been coming up and that we have been buying. So that's definitely a sector that looks good. Real estate, we rarely take a significant bet, and little, no, that's a very risky sector. And there's been a lot of, as far as the buyers are concerned, there's been a lot of speculative activity. I mean, I'm talking the actual buyers of the real estate, not the stock buyers. So that's not.
Devina, I want to press on the FMCG question, because
Right.
that is sort of a relatively unloved space, slow and steady, but doesn't really do much. What are you seeing as a differentiator here or a change? If you can just talk a bit more about why FMCG.
So actually, Tavana, this is the strange part. I mean, in 2020, it was the most beloved space. And then I had done actually a whole half-an-hour program on one of the business channels saying, just because you think the business is steady doesn't mean the stocks give steady returns. And there's a whole lot of history behind that. And there's so many times, long periods when they don't perform. And now it's come to the other side that, not worth looking at. So, but even in terms of fundamental, there are a couple of things that have changed. One, inflation is under control. So food inflation in particular, if you look at last couple of years, with the food inflation being that high and India being a relatively poor country, in a household budget, if dal and oil and all these prices go up, it actually crowds out the soaps and the shampoos. So, so there's relief on that side. Consumption, again, people started talking about a consumption slowdown when the after September, when the market corrected. But the real consumption slowdown was in 23-24. That year, in the GDP, the private consumption number was at a 21-year low. It grew less than 4%, I think 3.8 or something like that. So actually, 24-25 consumption has accelerated. Also, this is on the top line side. So if provided we have a decent monsoon, it's a good space. The other part is the margins. Again, some edible oils and which are used in FMCG, the prices have gone down. Crude is a big thing because ultimately a lot of downstream petrochemicals are used. Of course, they're used not just in FMCG, they're used in a whole lot of other industries as well. So on both the revenue side and the margin side, I think on the margin, the news is good. And as I said, the sector has not done well for a very long time. So on all our parameters, now it's coming up.
Okay, Devina Mehra, absolute delight talking to you after a really long time. So thank you so much for coming on air, and looking forward to talk to you soon.
Thank you.